Thank you very much for joining us today for this webinar. I see there are still some attendees joining, so let's give it another few seconds. All right, so welcome. As I said, thank you very much for taking the time to listen to our introduction to factor investing with machine learning today. I assume most of you already know Quantumrock, but let me say a few words about the firm. So we founded the firm back in 2012, and we spent quite a lot of time researching and developing our proprietary machine learning platform, which is at the core of everything we do. And then in 2016, we launched our first product, which is our Volatility Special Opportunities program. It's an efficient equity tail hedge product, which can be used to obviously hedge equity exposures. As I said, went live in 2016. It had quite a good year last year. We closed the year up more than 30%. The Sharpe ratio since inception is very good as well. It's at 1.6 roughly at the moment. And this product is built on our proprietary machine learning platform, which one of our speakers will later tell you a bit more about. This is what we spend most of the initial years of our existence researching and developing. And machine learning basically gives us the opportunity and the capability to explore and identify patterns that cannot be grasped by the human mind. But it also allows us to deal with the ever-changing market situation. So we're quite good at adapting to new market environments because we apply machine learning. So our latest model is obviously also based on this expertise and capability. So let's jump, obviously the known disclaimers, but let's jump to our agenda for today. So our latest model is a factor investing model, which was developed by our in-house team led by Michael Zeller, who's our Chief Investment Officer. He will be giving you an introduction to the fundamentals and the ideas behind factor investing today, and then later on a quick presentation of what a product could look like that is based on factor investing. We chose the S&P 500 as an index, but that is just an example. Michael will say more words about that later on. Michael, when developing this factor investing model, was supported by Dr. Gorbunov, who's our head of AI systems. He's obviously part of our AI development team, and he will be talking about why and how machine learning is changing factor investing, and will also give you a brief introduction to our AI platform, which is a white box AI, meaning we do understand everything that is happening, and we combine the human domain knowledge with machine learning methodologies. So my name is Timothy Lloyd. I'm responsible for our international business. So I'll be happy to be your point of contact after this webinar. We can then connect. My contact details are at the end of the presentation, so feel free to just reach out to me. Obviously, we would be very interested in your feedback, your input, your ideas after this presentation, but also during this presentation, there's a Q&A functionality which I would like to invite you to use. So I will collect the questions throughout the presentation, and then at the end, Michael and Roman will be happy to answer the questions. With that, I would like to hand over to Michael, who will then speak a bit about the ideas and fundamentals of factor investing.
Yes, hello. Thank you very much, Tim. So I would like to start by just talking a little bit about the origins and the history of factor investing. So in 1964, the so-called capital asset pricing model was developed. And therefore, first in time, we had a kind of separation of beta and alpha. And in the 70s, Horgan and Heinz came up with the idea that maybe low volatility stocks could outperform high volatility stocks, at least on a risk adjusted base. And they showed evidence that it is like they assumed that it could be. In the 1980s, there were two different things that came up in terms of factor investing. So Mr. Bunce found out that small caps tend to outperform large caps. That's the so-called size effect. And on the other hand, we have Mr. Bezu that found out that stocks with a low PE ratio usually tend to outperform stocks with a high PE ratio. That's the so-called value effect. And we all know the value and effect from Warren Buffett in that case, yes. In the 1990s, Farmer and French came up with the so-called three-factor model that added size and value factor to the beta factor, to the market factor. And therefore, they were able to describe or explain a lot more of single stock returns than it was able to do it by using the capital asset pricing model. In the same year, 1993, Jagadish and Titman found out that there is some kind of momentum factor. So there is a tendency that stocks that outperformed in the past, that they will tend to outperform in the future also. And stocks that underperformed, of course, they will have a tendency to underperform in the future. So that's the so-called momentum factor. It means finally that the relative performance of one stock is positively autocorrelated to itself. So in the year of 2003, the first so-called smart beta ETF was launched. All these factors are usually named by the name smart beta, yes, because if you invest in such a factor, it's more a kind of beta than a kind of alpha. So you will most probably get a kind of risk premium as you do if you would just invest in equity exposure or duration exposure. So people like to call then this kind of factor excess returns smart beta. So on the next slide, we will have some, on the next slide, we will have some different factors that could be used in factor investing. On the upper row, we see so-called macro factors. Macro factors can refer to economic developments, to inflation, to political issues, and so on. And on the other hand, we have the so-called style factors. As you can see, some of the style factors were already mentioned in the slide before. So we see here value, we see the size factor, we see the momentum factor, the low volatility factor. And here in addition, we see the dividend yield factor and the quality factor. But as you can assume, this number of factors is obviously extendable to a very high number, maybe even a number that goes up to infinity. I will speak later on about that. So on the next slide, the big question is, of course, why would you earn a kind of factor premium? What is the rationale behind it? What is the reason? So there are different explanations. So there's one explanation that bothers with the question if this might be a kind of risk premium, so that you get for bearing additional risks over the broad equity market if you, for example, get a kind of excess return. So for example, if you would refer to the so-called size factor, then we could maybe think, just a moment. Yes, sorry. So if we refer again to the size factor, then it could be that stocks with a low market capitalization also come along with low liquidity. So that means, of course, if you buy those stocks, most probably if you want to sell it one day, maybe even in a situation when the equity markets start to drop sharply and the market become more volatile, then you will face some risks in selling the stocks. And therefore, you maybe just face some liquidity risks. So it could then, that means, of course, it could be that by buying small cap stocks, you just bear an additional risk in terms of liquidity. So that would be one approach to explain the excess returns of the size factor. Another rationale could be the behavioral rationale. So, for example, let's talk about the momentum factor. It could be that people tend to extrapolate past observations into the future. So they would buy outperforming stocks in the expectation that this outperformance will just continue. Thus, a kind of self-fulfilling prophecy would occur, and the relative performance of the stocks would actually be positively autocorrelated. Would then finally mean that outperforming stocks would really outperform in the future, and underperforming stocks would really underperform in the future. So another explanation could be the market structure. For example, if we go again to the size factor, it could eventually be that for example, that there are some institutions that just have some restrictions. Yeah? They are not able to buy stocks with a market capitalization below a certain degree. And therefore, because they cannot buy it, most probably these stocks would be undervalued. And as they would be undervalued, that would mean, of course, that this undervaluation would have the potential to turn into later outperformance potential. So that would be an explanation coming from the market structures side or explanation. So on the next slide, we will have some further explanations on certain factors. So I would, in that case, refer to the low volatility, because in that, here you can describe very good how the different approaches look like, and what are the rationales behind. So for example, if you have low volatility, the low volatility factor could be explained by the fact that the associated leverage or deleveraging involves an interest rate risk. And this interest rate risk, of course, could be compensated by a risk premium. So maybe if you buy low volatility stocks, what you then really do is maybe buying equity exposure, and in addition, just buy a kind of duration exposure. So, and as we all know, the interest rates came down pretty much in the last decades. So it could be, for example, that you could explain a lot of the outperformance of the low volatility stocks just comes from the declining interest rates. But the other explanation, of course, could again refer to the behavioral explanations. So it could be that that the high volatility stocks just have some kind of lottery effects, leading to a preference for high volatility stocks with a small chance of large payouts. And therefore, low volatility stocks would be undervalued, what would then again lead to the outperformance potential in the future. So you see, we have the same factor, and you have a lot of explanations why we observe outperformance of these factors. So on the next slide, we are talking about some well-known factors here, like quality, volatility, momentum, value, and so on. And you see all these factors really have a kind of tendency to deliver excess returns to the broader equity markets. But what you can also see, of course, for example, if you take liquidity and size, because I argued before that size might just refer to the liquidity risk. That means, of course, that liquidity and size is correlated strongly. And maybe if you buy one of these factors, or maybe both factors, maybe you will buy the same risk twice. Yes. So the question, of course, is always how strong are these factors correlated to each other to then define the diversification potential of those factors if you would combine them. On the next slide, we will go a little bit deeper, because it's not about performance only in capital markets. it's always about risk-adjusted performance. So that means, of course, that all of these factors have a kind of volatility coming along with them. And so you have to compare, obviously, the excess returns against the relative volatility coming out of these factors. So the volatility, you can see it here marked with the red dots. And the excess performance, you can see it as bars. And what you see is that the bars are usually much lower than the analyzed volatilities. So that means that the Sharpe ratio is usually below 1, of course. But nevertheless, usually these kind of Sharpe ratios coming from these factors are, let's say, in between 0.1 and 0.4, something like that. Yeah. So on the next slide, you can see that's a very colorful picture. And what we wanted to show with the picture is that you cannot say that, for example, size is always the best factor in terms of excess return. Each year there will be another winner placed, and you can see by looking at the colorful picture that this is rotating and changing pretty much and pretty strong. So there will always be another winner every year. So that means, of course, that you can add some alpha in just selecting the right factor for the coming future. So on the next slide, we will show that what I already talked about, that it is very important that we have low correlations of the factors against each other, because only then we can really diversify the active risk. On the next slide, I want to talk a little bit why we try to apply machine learning to factor investing. This is just a snapshot coming from the Bloomberg terminal. Bloomberg defines, in that case, 195 different factors. And if you have a closer look at the so-called factors, you will see that most probably you could change something and then you would get even a bigger number of factors. For example, there on the downside, you see the momentum and the 3 years total return. Of course, you could expand it and also use the 2 years total return or the 3 months total return or the 85 days total return. So you can expand it maybe even almost to infinity. And this rule applies to almost all of these factors. So that means, of course, if you have such a large number of potential drivers and factors, it's for a human being almost impossible to make all the calculations. So for me in Excel, it would not be possible. So that means, of course, that's a topic that you can apply machine learning on very well, and with a good chance that you can get very good results out of it. So yes, that was from my side.
Thank you very much, Michael. I think this was already a very good introduction of Roman's topic. So Roman will now explain why we use machine learning to come up with better results in factor investing than our competitors.
Yes, thank you. So first of all, in my part of the presentation, I would like to explain the reasons why we use machine learning and also how exactly we do it or what are the details of our modeling approach. As Michael has already mentioned, one big issue is the data size. And to provide more details, in our data set, we have more than 20 different industry sectors. And for every sector, we have more than 20 stocks, and sometimes even much more than 20, like 50 or 60 stocks per sector. And for every stock, we have like 20 factors or even more, and we can also increase the size by defining new technical indicators. So we have much more than 20 features per stock. And finally, we have more than 20 years of history, and these are daily data. And obviously, these dimensions, so to say, are not additive, they are multiplicative. And if you multiply all these dimensions, all these combinatorics, then we get a data set with more than 100 million values in it. And of course, to analyze such a huge data set could be a very problematic or challenging for a human, but for machine learning, it's actually a perfect situation, because in the center of machine learning, we have data set, and the more data we have, the more chances we have to find useful, complex patterns, and more confidence we get about the statistical significance of those patterns. So basically, good or huge data set is what we need for machine learning, and this is a good thing for us. Among the other strengths of machine learning, I would like to mention that we always identify patterns with a backup of statistical tests. So basically, we always very confident about the presence of those patterns, and we are sure, thanks to the statistic, that the patterns that we find in the data are not just by chance, they are not random, and they are really exist in the data set. And finally, the patterns that we define with machine learning are usually non-trivial, complex, and even hard to formulate for a human. And the number of those patterns is extremely large, so it would be impossible for a human to kind of loop through all these patterns and check all of them. And for machine, it's obviously not a problem. And in that way, we can find complex, non-trivial, non-linear, multidimensional, fuzzy patterns. And this is what we do with machine learning. On the next slide, I would like to emphasize that besides machine learning, we also combine knowledge from other worlds. And of course, the first world that we use, or knowledge from a field that we use, is financial knowledge. And using financial knowledge, we define our stochastic model for the return. And I will speak about this in details later. Of course, we use machine learning, as we have already mentioned, and I will provide some more details about this also later. Finally, in addition to that, we use linear algebra to define optimal portfolio based on the results generated by the machine learning. And as I have already mentioned, we use mathematical statistics in order to define whether the patterns that you find or positive result that we have are real or they happen because of chance. On that folio, on this slide, you see colorful figures and colorful pictures. Basically, this is a demonstration of what kind of patterns we can define and describe with the help of machine learning, or more specifically with a neural network. So if you go from left to right, you can see patterns of increasing complexity, and this is achieved by increasing the size or number of neurons in a neural network. And then with the help of data, we decide what patterns we should accept, what patterns we should reject, and the more data we have, the more complex patterns we can define, like patterns that are on the right, but usually it's not the case. So usually in reality, we have something closer to the middle of this sequence of images. On the next slide, I would like to present our stochastic model, which we define with the help of financial knowledge. With this formula, we represent how we model returns of stocks. So on the left, you see R, which is a return of a stock I at time moment T. And we model these returns with formula containing two parts. On the left, we have in brackets what we call idiosyncratic part of the model. And this part describes the properties of the stock, which has nothing to do with the global market movement. So basically here we have alpha, which models the average or expected return of a given stock. And then we have gamma, which models the volatility or variance of the given stock. And epsilon is some unknown distribution, which is normalized, meaning that we have average equal to 0 and variance equal to 1. So basically, to model a stock or part of the return that have nothing to do with the market movement, we need to have two parameters per stock, which are alpha and gamma. And then the interesting part is the second part, where we have sum over J, and with that sum, we loop over different kinds of market movement. So in the simplest picture, we can say that market can just move either up or down. So we have just one type of movement, and every stock is sensitive to this movement to larger or smaller extent. So we can imagine that we have stocks that are very sensitive to the market movement. Then we have large beta in that case. We can have stocks that are less sensitive or not sensitive at all to the market movement. Then we have beta equal or close to 0. And we can also imagine that we have stocks with negative sensitivity, which means that if market goes up, then stock has a tendency to go down. And to make this model even more realistic and complex, we assume that we could have different types of market movements. And this is why we have sum of a J, and J is used to indicate different types of market movements. Then we can say that if let's say beta 3.7 would mean that this is a sensitivity of stock 3 to market movement 7. But usually we of course don't have so many types of market movements, but 2 or 3 might be a reasonable choice. And up to this point, we have no machine learning. It's just a stochastic model provided by the financial knowledge. And on the next slide, I would like to show how we can combine this stochastic model with a machine learning. So basically, one option would be to assign alpha, beta, and gamma to every stock. And then we have a complete description of the sector. However, instead of that, we assume that alpha for every stock can be calculated based on the factors associated with that stock. The same assumption we do about gamma and beta. So we say, as soon as we know the factors associated with the stock, we can use these factors as input to some unknown functions. And with these functions, we can calculate alpha, beta, and gammas. And the only goal here, or the only problem that we need to solve is to find those functions. And this is exactly what we do with machine learning, because machine learning is about finding functions based on data. On the next slide, I would like to provide more details about how exactly we do it. So the first thing, or the first idea that we use is that instead of searching for 3 or 4 separate functions that would give us a possibility to calculate alpha, beta, and gammas, we use one neural network shown, let's say, on that figures. And then what we have here on the left-hand side, we have 4 input nodes. And we use in that picture 4 factors from F1 to F4 as inputs to that neural network. Then we go through one hidden layer consisting of 3 neurons. And then finally, on the right-hand side, we get 4 values, which are alpha and betas and gamma corresponding to that particular stock. The nice thing about this approach is that we can very easily and flexibly control the expressive power of this model or complexity of the model. For example, on that picture, you see one hidden layer with 3 neurons, and we can control complexity of the function by increasing or decreasing the number of neurons. We can also increase the number of hidden layers. Like in that case, we have one hidden layer, we can use more hidden layers to make the function more complex. Another way where we can control the complexity of the model is on the left-hand side. In this picture, we see 4 factors, which means that we try to model a 4-dimensional function, but it might be the case that we don't have enough data to model such a complex function. Then we should reduce the number of factors. And in that case, we search for a function that uses only 1 or 2 factors. Or the other way around, it might be the case that we have a lot of data and data are clean. And then in that case, we can increase the complexity of the model by increasing the number of inputs that we use to calculate the financial parameters alpha, beta, and gamma. And finally, on the right-hand side, we see 2 betas. And as I have mentioned earlier, we can control complexity here by reducing or increasing the number of betas that we use to describe the sector of interest. On the next slide, I would like to present what we are doing if machine learning part is finished. So as soon as we have a neural network that we find with the help of data, we know full information needed to model the sector. And in particular, if we want to know, for example, correlation between 2 given stocks, we do it as follows. First of all, we take factors corresponding to the first stock. We use these factors as input to the neural network, and as output, we receive all alpha, betas, and gammas. And the same we do with the second stock. And if we have betas and gammas corresponding to every stock, we can use them in that formula. And as a result, analytically, we get covariance between 2 given stocks. And on the next slide, I present the next step in our modeling approach. So basically, our goal is to construct an optimal portfolio of stocks. And that means several things. On one hand side, we want to have stocks in the portfolio with large alpha, meaning that we want to have stocks that provide large expected return. On the other hand side, we don't want to have stocks that have a large volatility, which means that we don't want to have stocks that have large gamma and large beta. And finally, we also want to have such allocation for stocks that as soon as we have a large market move in one direction or another, we want to have returns from stock that compensate each other, that goes in different direction. In that case, we can reduce the influence of the market or stochasticity coming from the market into our portfolio. So basically, we need to balance between 3 different things, and it sounds like a complicated optimization problem, but we have an analytical solution for that. So basically, as soon as we know all the alphas and we know correlation between any pair of stocks, we have an analytical solution that provides us an exact allocation for every stock such that we maximize the Sharpe ratio of the portfolio. And this is written as a formula here. So basically what stands here, we use covariance metrics representing covariance between every pair of stocks. We use the expected returns of every stock. Everything is calculated based on the factors associated with stocks. And by using an analytical solution, we get as a result optimal allocation for every stock. And in that way, we solve the problem of optimal allocation for the portfolio. And that's it with my part. And thank you for the attention.
Thank you very much, Roman. So we now learned a lot about the background of factor investing and how machine learning can help us to build an excellent product. And now the question is, what could such a product look like? And Michael will now give you a bit of an insight into this question.
Yeah, thank you, Tim. So yes, exactly. On that slide, what you here can see is here a backtest. Of course, we did not trade it in this a real money track record so far. So that means, of course, this is a backtest, but I would say it's a very valid backtest because we have already some experiences with backtests and how to say comparing it to the real results, then finally just coming from the VSOP strategy. So what we here can see is we tried to build a portfolio that is very similar to the S&P 500, but with a tendency to outperform the S&P 500. And we traded it with an ex-ante tracking error of 350 basis points. So the final realized tracking error would have been at 3.29. So that means it comes pretty much along with what we assumed that it should be. So what you can see, of course, from that is that the risk associated, the relative risk associated with such an approach is pretty much under control. So that means in the case of the S&P 500, but of course this is only an example, the approach that we use can also be used for all other indices and different universes, of course. So you can also apply it, let's say, for the Stock 600 index or for the Nikkei index or whatever you want. So in that case, the S&P 500 is just a sample case, yes. So in that sample case, in the S&P 500 case, we were able to achieve an information ratio of 0.84. So that means in that case that we have an average excess return of more than 2.5%. And the volatility coming along with the product is pretty similar to the volatility coming from the S&P 500. So on the next slide, you will just see the historical data table. And what you then can see that the relative outperformance is pretty steady. So what of course also can be seen in the information ratio. As we all know, the information ratio is just the ratio of the relative return of the active return and just divided by the so-called tracking error. So that means in that case the volatility of the relative return. So on the next slide, you can find the yearly returns of the S&P 500 and our strategy. And in that case, you will also see that in most of the years, we can find the outperformance of our factor investing strategy. So on the next slide, slide 24, we have a chart with a rolling tracking error and a rolling information ratio. So as mentioned, we tried to aim ex-ante tracking error of 350 basis points. And what we then see here finally is the realized tracking error. And you can see it in the pink chart. The realized tracking error is usually not far away from the 350 basis points. So that means, of course, that the risk associated is pretty much under control. The information ratio is here in green, and what you can see that we are most of the times above 0. That means that we can really generate outperformance. Of course, in the cases when we are below 0, it would then finally mean that we have a negative active performance. So that means that we underperform the S&P 500 in that times. So, okay, that's about the product, referring in that case to the S&P 500. But as mentioned, we can apply this approach to almost every stock index that you can think of. And I even guess later on we could also apply it, of course, to credit indices. Okay. So maybe someone has questions or?
Yes, thank you very much, Michael. Thank you, Roman. If there are any more questions, please feel free to post them in the Q&A function. There is one question that might be more for Michael. Maybe Roman, you have some insights. The question is how or which kind of factors do we use? Do we only use the ones that you just showed on Bloomberg, or do we also come up with new factors that we constructed in-house?
Yeah, exactly. I think most of the factors that we use are constructed in-house. And based on machine learning, of course, we will further on develop other factors or use other factors.
Perfect. Thank you very much, Michael, for this. I think that is it for today from our side. If there are any more questions when you now sit down to think a bit more about this topic, we will share this presentation afterwards. So feel free to take a look. You can reach out to us anytime. My contact details are here on the last slide. So give me a call, send an email. I'd be happy to have a chat, and the team is also available to have a conversation with you. So as I said, we will share the slides, and then once we are ready to launch a product, obviously we will also reach out to you to keep you updated on our developments. But before that, happy to have a conversation anytime. So thank you very much again for our speakers today. Thank you for taking the time to listen to us today. Thank you for your questions, and hope to hear from you soon.
Thank you very much, and goodbye.
Thank you.